world economy is expected to be as weak as it was in 2009, right after the financial crisis. That's what the Institute of International Finance has said, adding that the conflict in Ukraine now risks becoming a forever war. Global growth is expected to slow to 1.2% in 2023. The slowdown will be led by Europe, which is impacted most by the war. In the US, the IIF expects gross domestic product to rise 1% next year, while Latin America is considered to be a positive standout, potentially expanding 1.2% as commodity exporters reap the benefits of high food and energy prices. And despite recent U-turns, the single biggest driver for the global economy next year will be China, where loosening COVID restrictions will be likely. For more on this now, let's go to Stephen Innes, who is SPI Asset Management Managing Partner in Bangkok. Stephen, many thanks for being with us today. First of all, what are the biggest problems for the economy going into next year? And is it likely that the growth might be similar to what we've observed in 2009, provided that there are major differences this time round?
Biggest impediment is central bank policy. I mean, they're hiking interest rates to defend against inflation. And they're going to continue to fight inflation, even at the expense of the economy. And I think we're starting to see this filter through into activity data. We saw the purchasing managers indexes come out through the world this week. They were all negative. And this is a sign that, maybe it's a sign that high interest rates are actually being effective in the sense that they'll start to slow down inflation. Fortunately, we do have some light at the end of the inflation tunnel in the sense that we look back at U.S. CPI inflation last month, it was much weaker. And I think the market's starting to filter in that as being a downtrend. A downtrend in inflation will cause central banks to take their foot off the rate hike accelerator. And that's what the market's pricing in right now.
Right, that's good news, actually. Do you think some analysts are saying that next year's recessions might be shallow, more shallow recession, because the labor market is tight? Do you agree? Is that helping in any way?
Yeah, I think the strong labor market helps, but I also think consumers' bank accounts are in a much better place right now than they were back in 2009. People are just wealthier, whether that's through homes or whether that's through stock market appreciation. I mean, everybody used those COVID checks to invest in the stock markets or cryptos or something. So people are a little bit better off right now, and I think this could help people get through the initial impact of what's expected to be a short recession.
Stephen Innes, many thanks for your analysis on global growth.